Sir, we are live now, sir. Ajay, sir.
Ajay, sir, you
Ajay,
mean?
sir. Yeah, Amish, sir, Ajay, sir, can you unmute yourself, sir?
Yeah,
Yeah.
I have unmuted.
Right, sir. So we'll start, sir. Now it's live on YouTube also.
Yeah, sure.
So
Go ahead.
welcome all dear participants. Greetings from Pediatric Academy of Telangana State. So myself, Dr. Pawan Kumar, and along with my lead coordinator, Dr. Ajay, sir, we are here to start a wonderful session by Dr. Amish Vora, sir, on diversification. So now I welcome Dr. Ajay Kumar sir, the lead coordinator for this vitamin F3, to give his initial remarks and how it has originated and how it has created a revolution in pediatricians' lives in the financial fitness program. Over to Dr. Ajay Kumar sir.
Good afternoon, everybody. Dr. Pawan, thank you very much for that wonderful introduction. As usual, your enthusiasm is very infectious. I welcome all the participants today on this Sunday, 25th August 2024 program of Team F3 from Pediatric Academy of Telangana in collaboration with Twin Cities branch of Hyderabad and Secunderabad IAP. This beautiful and wonderful and very liked and popular program, Zoom webinars, and from all over India. We have got participants and members in our WhatsApp group, almost like 1,600 doctors, pediatricians, learning, sharing, and helping each other and improving our knowledge on the personal finance management. As you know, Dr. Pawan was the secretary, state secretary, when he started mooting out this point to do the financial literacy for the doctors. And under that time President Dr. Surendranath, who's now the organizing secretary of the National Pedicon to be conducted in January 2025 in Hyderabad, was kind enough to start this program, and we are continuing. This is the third year, and slowly and steadily we have accumulated recorded webinars of about almost 65 to 70 videos freely available, uploaded in our YouTube channels, two channels, on a channel which is dedicated wholly and solely for the people who have missed earlier webinars, and wonderful and various diversified topics given by all the doctors, invited honorable guest speakers from all over India in different specialties in various topics, and they've been well received. I'm happy to tell you that we have now more than 540 subscribers to this channel. We have got more than 19,000 views on this channel for the exclusive personal financial management topics or videos, without cluttering, without confusing, without adding any other videos. And it is, each topic is worth in its gold, and taken by the pediatricians and by the various specialties like surgeon, anesthetist, pathologist, and pediatric surgeon, and they are all continuing to be in the group and teaching and learning from all of us. We have reached some of the videos more than 3,600 views, and they are very popular. I'll be very soon putting up the most popular videos in our WhatsApp group. If you have missed it, kindly watch them, take your time, and participate and learn what we are not learnt in our graduation or post-graduation day. Today, I'm very happy to welcome our guest speakers, invited speaker, Dr. Amish Vora. He is from Mumbai. He is a neonatologist. He has qualified and studied in UK. He has been to other countries, and also he's practicing and working in Mumbai. He's a wonderful speaker. He already spoke to us earlier on real estate. Very well viewed and appreciated talk on real estate, especially located in Mumbai. which is the commercial capital of India and also the real estate capital of India after Delhi probably. And today we have again Dr. Amish Vora, who was supposed to talk to us last month because of various logistics. We had to ask him to come today. And Dr. Amish Vora is going to talk on diversification. Diversification is the choice. And as you know, diversification is the buzzword now. It was associated by various experts, Nobel Prize winners in economy. Dr. Markowitz was the most important person comes to my mind who proposed diversification, not only in asset class, which Dr. Amish sir will tell us today, like what are the different risks which we mitigate and spread out the risk in our portfolio by diversifying our portfolio rather than concentrate on one or two asset classes or one or two industry sectors or one or two companies or firms, to dilute the risk and also to give a long picture of a good profitability. And we have got diversification, like nowadays people are talking, it is the buzzword again, to invest abroad. So there is a market diversification geographically, topographically, industrial, and also commodity, currency, real estate, gold, stocks like bonds, shares. These are the various things which comes to my mind. And I hope Dr. Amish sir's talk today will be an eye-opener and also a learning point from where we go forward to diversify our portfolios and increase our returns optimally and also superiorly than the index, hopefully. And I request all the participants to do at least one transaction in your portfolio by selling one portfolio, one share or one stock, so that you are aware how to churn it when the time comes at the end of the talk. What is diversification if it is very concentrated portfolio? So I now hand over the platform to Dr. Amish Vora sir, and I request all the participants to focus, attentively listen and post your questions. End of the session, we'll have question and answer sessions, and take notes and be profitable and diversify your topics with Dr. Amish Vora today. Over to Dr. Amish Vora, sir.
Thank you, sir. Okay, I hope my screen is seen easily by everyone.
Yes, sir. You are visible and heard.
Okay. Okay. So first of all, thanks for the good introduction by Dr. Ajoy sir. And thanks for IAP Telangana and the twin cities of Hyderabad and Secunderabad to giving me this opportunity to speak on diversification. And I've been part of it for the last 3 years. And it's been an interesting learning curve as well with me, with all my, with Ajoy sir leading as a mentor, with Kumar sir as a good force behind us, and a good colleagues like Harish, Prof. Shape Soran and Naresh Bihani. All of us have formed a good group and we are going forward with that. So with that, I'll start with my presentation, which is on diversification. And I feel that diversification should be as a rule, which everybody should do when they're creating their wealth. Okay. As a disclaimer, investment is market risk 100%. I'm not a financial consultant, so please consult your financial. This is for education, learning, and knowledge purpose. I have no responsibilities or intent for any decision or financial losses you make. Do your own analysis, calculations, and equity and mutual funds are risky. I do not provide any tips or recommendation or advice. This is just a knowledge base, and do as you feel anything useful, please analyze it further. So before I start, everything you feel like when you have something about your personal finances. So these are my 10 commandments, which I've learned over the last 30 to 40 years. And what are those? Your money, you care the most. Okay, it's your money. No one else will care for your money, your hard-earned money, how you have struggled to get that money. So at the end of the day, you care most for your money. So please use it preciously. Don't invest arbitrarily. Somebody said this, start investing. Somebody says this, start investing. Have a contingent fund. Have a contingent fund where for your any expenses, your monthly expenses, if you have 4x to 6x of your monthly expenses should be a contingent fund, which is an emergency fund. First rule, always keep that as an emergency fund aside, which you're not going to touch for anything. Second, have a good health insurance, have a good pure term insurance. All these commandments are mostly which you have heard before. I'm just reiterating, especially for new younger groups, for them to know. Look at your assets allocations. So this is a very important point which you'll go through when I'll go through my slides, how it's important to diversify. Basic point, gold is gold and gold will always remain gold and that will not change. Real estate rarely loses money. As I said, I'm somebody who's interested in real estate. I made most of my wealth from real estate and hence I strongly support it. But that could be my biased view, but you should see how you can diversify. Avoid for real estate or anything, don't avoid high cost debt. Do not take a big loan. If you're taking any loan, your EMI should not cross more than 30% of your income. That should be your basic rule. And loan should be for wealth creation. You should not be taking loans for your wants and your needs. Simplify way to invest in mutual fund is your index funds. Create a small concentrated 4 to 6 mutual funds or index funds or ETF. 4 to 6 is diversified enough to cover the whole spectrum of investment in mutual funds or index funds. And we'll go through it when we go through the whole the detailed program. Direct stock. Direct stock should involve 15 to 20, maximum 25 stocks. That shows that you are concentrated as well as diversified to take care of your risk versus reward benefit. You don't want to dilute so much that when the stock does well, you don't earn. At the same time, you don't want it concentrated. When the stock falls, you lose. So I think 15 to 20, I'll show you the papers which says that that's an ideal figure. Do not indulge in reckless behavior like F&O or speculative activities. Compounding needs time. For your money to make money, for you to get your returns, take times. Usually we say minimum 10 years, average period 20 to 30 years. Okay, so remember this. Remember that the Rome was not built in a day. But if you risk it in F&O or transactions, it can be burned in one. Okay, so these are the basic 10 commandments I want you to remember when we talk about diversifying and see what you go about it. Most of you know about it, but it's important to reiterate the same points so it gets grilled into our day-to-day life. When we invest, my simple goal is when I'm investing, I have to be smart. I have to smart. What does smart mean? I have to have a specific goal, specific reason why I'm investing. Whether I'm investing in 1 to 3 years for my vacation, I want to start a business, I want to start a hospital, I want to buy a car, or long term, like I want to buy a house. Most important, I want my retirement as my first thing, then my house as a second, my child's education as third, and my child's marriage as fourth. So that should be your plan for more than 5 years. So you have a goal for which you specifically invest. The goal, when you're investing something, you have to know that how you're going to measure what you have achieved and whether it's easily achievable and it's realistic. And you need to have a time bound. Okay, retirement start 65, 70 or 60, 65. Buying house 5 to 10 years. Children's education 10 to 15 years. Child's marriage another 20 years. Or you have a short term, want to build a hospital, 3 years. So you have to have a goal from which you can measure and you can see why you're investing. Having investment without a goal is a blind leading a blind. You do not know what you're doing, then your measurement becomes difficult. Whether you achieved is difficult, and you'll not have a time frame why you're doing it. Similarly, the 10 essentials or the 10 rules, as we said just now, goal. Second, do not get influenced by action of others. मेरा friend ने ये किया, मैंने ये किया, मेरे को tip मिला, I'll do this, I'll do that. That all does not work. Okay? Do as your own what you are planning. Before you plan, do a proper research before investing. Most important, never try to time the market. Market upper hai, market niche hai, whatever it is. No. Time in the market is more important than trying to time the market. Do your investment, number 5, do your investment systematically. While investing, number 6, don't get emotional or don't jump into conclusions. 7, as we say, which we are talking about, is make sure your portfolio is diversified. 8, invest your surplus fund. So always make sure your basic emergency funds are kept aside and you're investing your surplus fund. You need to continuously monitor your portfolio. And monitor means I do not mean by saying day to day. Okay, in the end, we'll tell you how you to monitor it. And again, keep a long-term investment approach. For compounding, you need to invest for more than 20 to 30 years, and then you'll see the real fun of it. Why am I talking this? Unlike this group where you learned a lot, I had a very rocky start. It took me a long time and I had a lot of, it's like a child walking and falling before I could have run. So I started doing in 1988, I started investing after seeing the good movie by Stock by Gordon Greco. And that's when and Harshad Mehta started. I was in science studying and my friends were in commerce and they were making money and they started doing tip trading. I was enjoying tip trading in 1989. After my 12th, I was studying, I had money. I went for East Asia trip. I was doing well. When my sister got married, I learned about importance of gold. One of my friend had a gold business. He said, don't give jewelry. The gold value goes down. Why don't you give a gold bar to your sister on a marriage? I said I had money. I gave him. And then what happens? It all came tumbling down. Harshad Mehta nearly bankrupted me. My sister helped me, gave me the bar back to pay some of the loans. My father helped me to make sure that I pay away all my dues. But he didn't give me unnecessary. For next 1 year, I worked as a peon in his office after my medical school. So nothing comes free to make me realize. After that, I thought I'll take help of experts. So I started using experts and brokers and agents, which helped me to start building my equity portfolio again. My hard-earned money, I would invest what they say. And they all said IT is the next future. IT is great until the 2000, the dot-com boom, where everything fell down. And then I realized through my tumble and turns, over 12 years, that whatever I had invested, most of it had evaporated. And I decided that I need to start studying myself. And that's why I started studying. I thought that I can't invest in equity. And that's when I first time started investing in mutual funds investment. We had a bad experience that time with UTI, but that's where we started investing. I realized equity was not for me. I started feeling that with all my other colleagues, if I talk about my real estate, I started buying real estate. As you can see, I bought a real estate in 2002 and 2004, then 2007, and then in 2010. All these real estates were not for myself, but it was a commercial or rental property for me to make money. Until in 2015, when I bought my house and I sold most of the other real estates and make sure that when I buy my house, it is rent-free. And I have one more property left just now for me to rent. Most of the property, 2002, I bought in Australia. 2004, I bought in London. 2007, I bought in America. 2010, I bought in Dubai. And 2015, I bought in India. I sold most of them at a good profit, except the Dubai one. The Dubai one I sold in 2015 where the market was at a downward stand. I did not lose much, but I lost 5 to 10%. So when you invest, it shows the same thing. When you invest for less than 5 to 7 years, you can go through the cycle. The cycle will go through when we are talking. While I was investing in real estate, I also started learning of derivatives. Derivatives was a big thing in London in those stages, and all of us were playing around with doing derivatives. While doing derivatives, I was earning over there, and I went back into the fundamentals of equity, buying equity as per se in the UK and India market. Luckily, by 2007, started getting feeling a lot of the buzzwords were coming, that derivatives getting very risky, and people have started losing money. Luckily, from my earlier mistakes, I learned. In 2007, I stopped derivatives. And that was very helpful. By 2008, the market collapsed. Market collapse. I was so happy that I saved money, but I did not invest. With collapse market for 2-3 years, I did not invest until 2010. I bought in Dubai. Saved that money for 2-3 years and used that to buy another property. But unlike that, I kept on investing and I learned whenever you have an opportunity, when the market is down, grab that opportunity and did so in 2020. Most of the times, as you can see that in equity, I was often losing money until I started properly in 2005. And hence, I was always hesitant and I would only do fundamental investment in equity. Obviously, over the last 2-3 years, dealing with Professor Shape, with my friend Naresh, with other friends in the group, I've learned about trading. I learned about trading for the last 2-3 years. And after that, this year is the first time I've started doing trading. So you see, investment is a journey which you have to go and play yourself. Luckily for you all, with sirs and all the advices with the internet, it's easy that you don't make the mistakes we make. There's so much you can read, write, and learn from your mentors and your other colleagues that you don't make the same mistakes. I feel that going through this journey, which we all have gone, it cuts short your mistake time by more than 50%. Nothing is 100%, but you can learn from a mistake, and hopefully all these lectures are useful and you can learn how you can grow yourself and create a passive investment. Why are we interested in earning or having a wealth? There are two types of investment. One is active investment, which you do for your primary profession. As a doctor, what we do to learn our profession, to make our money from a hospital or clinic, that all is active investment. That is your earning your day-to-day. Passive investment is the money you earn. You invest, that after some time, it starts growing. The money starts making money. Money starts working for you after 7 to 10 years. And the idea of any passive investment is it should beat the inflation plus 3 to 4% more than the inflation. So what are the passive income? So as I said that for me, the eye-opener was Wall Street movie. Michael Douglas movie, 1987. I saw that movie nearly 3 to 4 times. And the word he said was, greed is good. Okay, so diversification in greed is good. At that time in 87, 89, we only thought of equity. But now, over the last 15, 20 years, we have expanded the word of greed. Initially, we should think of greed as only GRE, gold, real estate, and equity. Now we know the full form of greed is G for gold, R for real estate, E for equity, important another E for mutual fund, and D for debt funds. So it's important to know the whole state. And aim, goal. Aim and the goal, if your aim and goal is retirement, so you should see that by age of 60 or 65, you should nearly have equally 20% of diversified portfolio. This is what theoretically people say. I feel more equivalent or more easily possible is 10% in gold, 10% in debt funds, 40 in real estate, and 40 in equity divided between mutual funds and equity direct. This gives you a good diversified portfolio. But whatever you're good at, like I said, I was good at real estate, so I'm giving 40-40. Okay, if you think you're better at equity, direct equity, you can make direct equity 30 and you can decrease the other two. But the whole idea is that you have to have a diversified portfolio because it becomes balanced investment. I will go in detail about that and you'll see how it goes about. Most important is earlier you start, the better it is. Always the first income you get, you should always invest. Diversified portfolio is like your wheel of wealth creation. To have a smooth running wheel, you need to have everything: equity, portfolio, bonds, cash, and gold. Okay, and you can see that it's all are nearly in the same persona. Before we diversify, some basic principle of financial rules. Important that we know that, as we spoke about, people are told about, you have to have a health insurance. Initially in your life, you should have a term life insurance, 20x of your income. You have to have 3x or 6x emergency rule, which is 3x is your monthly, 3 times your monthly expenses for less than 30 years. And for more than 30 years, I say 6 times your monthly expenses. You need to know rule of 72. How long it takes to double your money. Rule of 140 or rule of 144 to quadruple. We'll go in detail. Rule of 70, your inflation will go there. What is the rule of 50, 30, 20? I'll explain you in detail. 30% EMI rule that we said before, your EMI should not be more than 30% of your income. Your retirement fund should be such that you can just withdraw 4% of it every month, and that should give you enough 4% annually, and that should give you enough money for you to retire. 10, as we said before, invest as early as possible. It's never too late. Even if you're 30 and 40 and 50s, come on, at the age of more than 50, I'm now learning to invest in trading equity. So, it's never too late to try anything. So rule of 72. So rule of 72 is simple, that how long it takes you to double your money. If you're getting return of investment is 8%, in an FD or in a debt fund, you're getting 8%. 78 divided by 8 is 9. So your money will double in 9 years. If you do in equity, the percentage is 12. So 72 divided by 12 will be 6. Similarly, to triple, it's 144 divided by 12. It's 9.5 years. To quadruple, 144 divided by 12, it takes 12 years to multiply 4 times. This is talking about your initial investment only. Important thing is, the money you double or you triple, if you keep in your own, in the same amount, you start creating compounding, you start creating wealth, where the original invested money and the return you received previously is all are still in the market. Then they work to make sure your profit also starts working for you, and that helps you in compounding. Suppose I put a money, okay, in 2 years, I got a return in 12%. My money doubled in 6 years. Okay, so in 6 years, my money doubled. So my original investment plus my return is still invested. In 9 years, it will become 3x. So my 3x of my money has become triple the money. So my CAGR, which was initially 12%, will go up to 22%, approximately, okay, between 20 to 22%. And similarly, it becomes 4 times. If I continue to multiply, it becomes 4 times. My CAGR will be up to 25%. So, to compound your money, let the money be in the market, let it grow. Don't try to cut the wings and remove the money when it's doing. Some people like to do profit booking. That's fine when you're doing in equity, when you're a pro. But as a beginner, as a rule, I would say always somebody who is flying, let the wings spread and keep on flying. We spoke about emergency rule of 3x, CX. The idea is that if you're less than 30, if your monthly income is 50, monthly expense is 50,000, 3 times of that, 1,50,000, you should keep it as a side. Once you are more than 30, if your annual monthly expense is 6 lakhs, you have to keep it aside. Okay, keep it in cash accounts or arbitrage fund. We'll talk about that. So this is what it is showing. Another important rule one should follow is inflation. Okay, when the money is growing, one should not forget that the money also gets devalued. Okay, currently the inflation is about 7%. So if your inflation is 7 and the rule of 70, 7 divided by 7 is 10. Your money becomes half. If you invest 1 lakh, after 10 years, your money has become 5 lakhs. Okay, so you need to make sure that you're getting 3x of it by 9 years. So you're making more money, knowing that you still have double your money after 10 years, correcting for the inflation. So it's very important when you're investing, do not only look at the CAGR, do not only look at the return, but also make sure that how much your money is getting devalued, so you can do your absolute return on that. 50-30 rules. A lot of people have 50-30 rules for all the age group. I feel that's rubbish. 50-30 rules for different age groups should be different. For below 30, most of us are bachelor, have very small needs and very small wants. Below 30 is a right time to invest, where 50% of your savings should go into investment, 30% should go in your needs, and your wants should be 20%. Not like today's generation where, everybody wants iPhone. If a phone can get along with just saying simple Oppo or other phones, why not use that? Why do you need iPhone or Samsung? Okay, and it's a want, it's not a need. Okay, your need has to be basic, what you are eating, okay, where you are living. Hostel room, dormitory room is good enough. That's a basic life money saved. So you are appearing. Why do you want to rent a room and go out and take a flat for rental and destroy your money? So it's very important that 50% of things you invest. As you grow older, by 30, you might either get married, you might have kids, so your needs go up. Then your money should be 50% needs, but you should always aim for 30% of your money you're making for your savings, and then you think of 20% of your wants. Finally, once you're above 50, I feel that it's time that you, for last 50 years, you have saved your money. Okay, you are achieving your program because you're doing it for last 20 years. Like sometimes like compounding starts taking an effect after 10 years, 12 years, I said. So you can be a little bit better. Do not stop your saving. You can decrease your savings to 20. Your needs will remain 50 because you'll have kids who will be about to go for the education or the marriage, but your wants can increase. You can just help yourself and give some luxury in life. So what are the 8 secrets of the very rich people, which I found this very beautiful cartoon? Goal. Focus on your major goals. As we said, first save, then spend. Create multiple income stream. Most important asset is you. Keep learning, become an expert. Invest in assets you understand. As initially I didn't understand equity. I lost. I understood real estate. I started investing in real estate. Be willing to take calculated risk. Use your money wisely and stop consuming. Stop having wants. So these are very important things which I found, and I said you should look into it. Retirement, everybody's spoken about it. You have a good talk on the YouTube, but as we said, basically your corpus of retirement should be 25x of your estimated annual expenses. So why invest? Investing allows money. Invest money now allows you to have financial flexibility in your future. The earlier you start to investing, the easier it becomes to establish large amount of money. Simple point, if you invest at 20 and you invest same amount and invest in 30, the final point which you invest, what money you get after when you are retiring at 65, there'll be a difference of nearly 100,000. Okay, so it's important to start investing early, and it's never too late. Okay, only thing is if you're investing early, you can use 5,000 rupees. If you're investing in 30, you have to use 10,000. When you're investing later in your life, you have to use 40 and 50,000. So, your earlier investment, every monthly SIP or investment plan should increase. So let's talk about greed. The importance of greed is always whatever you invest, you should have the 4 pillars in your mind. First, what's the return I'm going to get? What are the safety? What is the risk of volatility? And if I need money, what is the liquidity? Forget looking at all of them, okay? So let's look at equity, gold, real estate, and mutual funds. These are the 4 things we'll be concentrating on in this talk. So in equity, your returns are moderate to high. In gold, your returns are moderate, obviously not as good as equity. In real estate, especially in India, it's moderate to high, okay? And in your mutual funds, is the same as equity, is moderate to high. So all of them are giving you moderate to high returns. Safety-wise, equity safety is a little bit low, it's slightly more high risk. So you need to do your due diligence. You have seen from my example. Gold, the safety is high. Real estate, I would say they say moderate because this is from UK. But if you look at India, the real estate is usually quite safe. Mutual funds, the safety is high because you're investing on either index or by experts, and hopefully they're investing better, unless you have a bad experience like we had with our UTI units in the past. Volatility. What is the fluctuation? What is the fluctuation and what is the risk I'm taking? Equity is high. Mutual fund is high. They even say real estate is high volatility. Okay, but it depends on how you invest in it. Gold is the only one which has a low volatility. Okay. At the same time, I would say that gold as liquidity is very easy in India, especially for the other part. Mutual fund liquidity is high. Equity liquidity can be low to high. Real estate is that to liquidate real estate, it takes time and is low. So you have to balance the liquidity with volatility, with your safety and your return. The liquidity in real estate is low. the safety is high to moderate. Equity, the returns are high, the safety is low. Mutual funds, high safety, high liquidity. The risk is moderate. So you can see that what is happening over here. Same thing with gold. High safety, moderate volatility, and easy to moderate liquidity. So where we are going. So let's start with the first greed, which is gold. Aim to have gold as a 10% of your portfolio. If you look over the last 25 years, the return by gold and Sensex, as you can see, is nearly same. Okay, so if you are invested in gold at 18,500, it will become 73,000. And if you are invested in Sensex at that time, it will be same. Obviously, Sensex is more. And this is over the period of 20 years. Look at the returns of gold when the gold was separated from dollar. So 1971 when it happened, hence we can only see gold as a standard from 72. You look at the gold and S&P, the equity of USA, the return of each decade. Okay, gold return was high. In the first decade, S&P was low. Equity was low. Second decade, vice versa. Gold goes down, equity goes up. Third time, during the dot-com boom, again, gold goes up, equity comes down. Fourth phase, gold goes down, equity comes up. So you can see that both are going hand in hand. One is going down, other is going up. Other is going down, other is going up. And which is why the real winner is neither stock nor gold. Hence, you have to remember that when you invest the tough time, there's no single asset class you should maintain by. Hence, diversified portfolio of having stocks, bond, real estate, and commodities are the most important thing which they have mentioned. Combining assets has shown to reduce overall portfolio risk and improve risk adjustment return. Hence, as this looking at gold and equity over 4 decades in America, you can see that how it's helpful to invest in gold and equity direct. Going back to the same slide we showed before, to revise yourself, you can see the returns in gold and Sensex. And if you look at Indian investment over last 10 years, okay, this is for Money Time, and you can see that last 1 year, this is gold and this is equity, Sensex, BSE. Both have been about 18%. If you look at 3 years, gold is slightly above at 14.2 and equity is down at 13.6. 5 years, remember, this is when we had the 2020 big drop in equity, and last year when the gold has done well, last 1 year. Hence, over last 5 years, gold has gone above the equity in the return. Overall, we should look at the 10-year picture. Equity gives you about 12 to 14%. Gold gives you about 9 to 10%. Okay, so this is very important to see your return of investment over 10 to 20 years, and this is how it keeps on going, having your returns about with gold and equity. We see that the other returns are all less than inflation, about 7 to 8%, and this are your cash and the fixed income group. So we'll not discuss about that. When you buy gold, which is the right way to buy gold? Okay, there are a lot of figures. As we know, till now, we always used to say SGB is the best. SGB is the best because it used to give you best returns with like something like dividend or real estate. It used to give you 2% per annum money on it, like dividend. And hence it used to come to 12%. But sadly, government has realized, RBI has realized, and they're going to start stopping SGB. So the next best method is gold ETF. Okay, people say physical gold is not good. We are Indians. When you have a lot of cash, having some physical gold, as I've realized, when I went down and my sister gave me the gold bar first, I feel that having, as the government of India allows you some amount of the gold to keep in the physical form, that much amount I feel everybody should keep it as a part of their emergency. Where's gold heading? The gold, when we made this talk, as he said, in May, was sitting at 2,400. Okay, see the big jump in gold in last 1 year. And the head of the Citibank in America says he sees gold by reaching 3,000. And I agree with him. I feel he thinks it's by 25. I feel by 2030, gold will be anywhere between 3,000. And why about us? You see that gold has become, when is the right time to buy? As I said, don't try to time your market. You have money, you want to diversify your portfolio, start putting 1 to 2% of your portfolio into gold every year. RBI itself has bought more gold this year. This year it's bought, in first quarter of this year, it's bought more than the whole gold they bought in 2023. Hence, RBI feels now that it has enough gold. It does not need to buy more gold. Hence, they might be planning to stop the SGB. If the SGB comes back, use that opportunity, and whatever cash, whatever money you have, just buy the SGB and be saved in for the next 8 years. Next is real estate. Real estate, I will not talk much. People have my YouTube and everybody, and you can look into it. But I feel that real estate is a good passive income. The rent can make a good passive income. It is a moderate risk. It gives you a return of nearly 10%, which is CAGR plus 2 to 4%. It is a lifelong passive investment. When you retire, you can get your passive investment from it. When you retire, you can always reverse mortgage it and get your money back. Very smartly, if you want to mortgage you always, as we said, always first 2-3 properties, buy to create wealth, reinvest in 5 to 7 years, remortgage it, remove your income from it. Then the whole property is free for you. Invest that to buy your second property. And that's a way to make sure get your original investment out. How to get EMI free. Dr. Harsh has given a good talk on how to make zero maintenance and cost of your real estate. And as I said last time also, consider buying a real estate as a company. As we said, the advantage of being a company is much more. We always said that the indexation would go. They nearly try to take the indexation benefit. I think real estate as a free inheritance will go away in some time, and at least I'm sure during my lifetime. So if you have a real estate in personal name, if you give it to your kids, they will have to pay inheritance. But if you buy it as a company, you give it to your kids, they have got a company, there will be no inheritance in company as yet, but that's for the time to say. Anything like real estate or anything goes through a cycle. The cycle is whether you have a recession, you have recovery, then you have expansion, and then you have contraction. At present, real estate and equity both are in expansion too, on the top of its wing. How it goes, nobody can say. Okay, real estate is booming, equity is booming. When it will lead to contraction, but we know through the cycle, it will go to recession. We have to bear it out when it goes to recession. Wait it starts recovering and start adding when you're recovering. When we are at its peak, we do not know when the peak comes. We can see the peak and bottom, but this is a time to be safe, whether you to see what you're going to invest in. Why the real estate going? There are many reasons why it's growing, but the most important thing is newer generations don't want to buy real estate. A lot of people are advising don't buy real estate. It's good for people like us. Because newer generation is not buying real estate, the rental prices have gone up like anything. In last 2 years, the rental prices have gone up by 30%. So 15% dividend has come up more. Okay, the population is growing, population is migrating. There is a lot of huge demand for rental houses. Okay, and the interest rate on the mortgages are coming down. I'm sure the interest rate in the mortgage will come down again in next year. The biggest rental property in the world is Burj Khalifa, 160 floors, all made for rental income. Okay, real estate, as we said before, can be multi-bagger. The Burj Khalifa, the Dubai property, I sold at a loss in 2015, but I kept it for 10 more years. I would have had about 50% more profit if I'd kept it for another 5 years. Okay. Real estate, each city is showing a big boom, especially from 22 to 23 and even from 23 to 25. In Bombay, it was 18% in 22 to 23. It's up by 15% from 23 to 24. Okay. Delhi, Hyderabad has rocked up. It's been rocking up for the last 2 to 3 years. I think it's reached its plateau phase. Pune, Bangalore, and Chennai still have to catch up. So overall, real estate is catching up. The question should not be real estate versus equity. The question should be do both. Both will give you rental or dividend yield. Both will have capital appreciation or price increase. And the important thing is, when this is real estate, this is equity. When real estate comes down, your equity goes up. When real equity starts coming down, your real estate starts going up. This is a golden period where we are going through, where both real estate and equity are going up. Enjoy this period while it lasts. If somebody in 1988 had put 6 rupees in both real estate and equity, okay, green is blue is equity, red is real estate, they would have made in 2017 nearly same return. This is a beautiful article I saw about a young couple who have retired. And as you can see that till 2000, Okay, 10 years, 15 years before he was retiring, he had majority in real estate and 5% in debt. Light blue is debt and the dark blue is your real estate. Okay, once it's thought that now I've had enough income, he understood this. He was investing in real estate. Okay, then slowly decreases real estate and he started this pink, he started adding his equity. Also, he started increasing his debt fund. Now, when he's retiring, he's got rid of his real estate. As obviously in 2022, there's not much knowledge. So he's put 50% in equity, okay, 30 to 40% in debt, and another 10% and something in gold and all that. So you can see how you can create wealth. You can create wealth by diversifying and what you know well. Okay, he was lucky at that time that he had only in equity and debt, but I feel that one should just quietly from beginning aim for something like a balanced portfolio. Equity return in most of the countries over last 10 years has given a return of nearly 9% in India. As we said, the rental income in India has shot up, especially with cities like Noida, Gurgaon, Bangalore, 30%. Even Bombay has increased by 30%. Each and every real rental property, either you accept the new rate or you leave. And people have been told to leave, and everybody is asking for higher real estate, higher rent. Next, and the most important, is mutual fund. Mutual fund is a trust that pools the saving of several. Mutual fund is a trust. Everybody puts money in it, and the company in that will go and buy equity. Okay, they are the experts. You can start mutual funds with small 100 rupees, 1,000 rupees, or 1 lakh rupee. Everybody in turns. But in equity, it depends on the market. Depends on the market, and they cannot assure you that there's a confirmed fixed returns. Like anything, but if you put for long term, the risk goes down and the reward goes up. Mutual fund is a most cost-effective way to invest in financial products. Look at the returns. Okay, this is obviously in my old slide, which is from 2004 to 2009, where everything had crashed. But I feel that it represents what's going on more. Okay, this is the mutual fund. Between 2004 to 2009, the mutual funds did better than Sensex. Okay, equity, well, the gold also did better, and especially you see in 2009 and 10 when the market had crashed, gold had overshoot everything, and your inflation and your bonds are somewhere at the bottom. So you see that investing in mutual fund is helpful when over last 5 to 10 years. The advantage is it's professionally managed. It diversifies into different portfolios in the different equities. It is gives a good return. It is low cost. Depending on what type of mutual funds you take, it is easily liquidated. Once you want to sell within 3 days, you can get money. They are very transparent, very important. What they do, you can see it any time of day and night. They are quite flexible on what to do. At the same time, you have choice of schemes you want to invest in what mutual funds. The mutual funds are well regulated, and they are mutual funds which have tax benefits. I would not advise you to invest in mutual funds for tax benefit, but there are mutual funds which are there for tax benefit. There are two types of mutual funds, debt and equity. Okay, debt funds, when you put in the debt funds or mutual funds, we'll talk more about it later, but there's liquid funds and short-term funds. While equity, you have your index funds, your arbitrage fund, your balance funds, and your sectoral funds. So these are the various mutual funds you can invest in. In the mutual funds, you have capital preservations, something to generate income, something to make sure you have capital appreciation. This is what you're looking for. Your capital preservation is like your saving bank or PPF. You can put in liquid funds, as we spoke about. Generate income, you can put in fixed deposit and your post office. It's like your debt funds, slightly more. You get slightly same return, about 8 to 9%. Most important is your capital appreciation. It's your equity. You should invest in mutual funds, which are equity funds. It gives you same like your real estate and gold. So how do I make money from mutual funds? As we said, you buy a mutual fund of and net asset value, the value of the mutual funds, you buy for 100 rupees. They appreciate over the time, and that is called as capital appreciation. At the same time, you can have income coming. You can take dividend-paying mutual funds. We do not advise that, but you can take dividend-paying mutual funds, especially after you retire, and then they can give you money. Okay. Income distribution. When you do not take dividend, the dividend gets reinvested in your mutual fund, it causes income distribution or direct fund, and that's why your mutual fund asset value increases more. How to invest in mutual funds? Just some basic steps. Okay, identify what you need. Always have your goal. How much risk you're going to take. Look at the right mutual fund for that, and then find the right selections. How are you going to select the mutual funds? There are various funds. The most important for us is debt fund, equity fund, or hybrid fund. An important thing is passive fund and active fund. So we'll concentrate a little bit on this. Mutual fund is a beautiful talk given by a lot of our colleagues before, and please look at those videos in your time. But important thing is mutual funds can be debt fund, which is a safe fund. Okay, you put in it, but you can get a regular income out of it, or you put in equity fund, which will compound as a higher risk. One, at the same time, always advise that not to put everything in equity. You can consider putting some part of your mutual fund. If you're putting 20% in equity fund in your mutual funds, 15% in equity, 5% in hybrid fund, gives the balanced equity fund and hybrid fund. So giving a property of 15% and 5% of your mutual fund portfolio, divide between equity and hybrid, gives a good sum. The major change has happened in the last 5 to 10 years. Since 2010, the mutual funds have come of two types, passive funds and active funds. Passive funds are the funds which go by the market indices. It is very secure, gives you good return as per the market. The fund managers do not try to play with the stock, the sector in which you have, the market you have which invested. If you put in Nifty 50, the funds will change in the Nifty 50. If the equity, if the company comes out of Nifty 50 and the new company comes, the fund will diversify itself. The biggest advantage of passive investment is expenses are very lower, and I'll show you how it differs. The thing about active fund is, active fund was something which came in the first came, people are talking very highly about it, but over the last 7 years, we'll see how active funds have performing less, and how the expenses of the active funds are making it more and more less lucrative compared to passive funds. But still, it's your own decision. Please have a look and decide. Important in mutual fund is lump sum investment. Do a lump sum investment. Whenever you have money, do your investment. Do one time. People do systematic investment. Do it as divide your lump sum into 25%, put 25% over 4 months. I don't believe. I believe when you have lump sum, please invest. Time in the market is most important. Somebody had asked me about 4 months back. No, I'm going to divide into 4 months. In that 2 months, first 2 months, market went up by 10%. Okay. So when you are deciding on your lump sum, usually see what the market is doing. If market is going stable or going up, don't worry. At the end of the day, after 10, 15 years, it makes no difference whether you did lump sum or you divided your lump sum into 4 or 6. Most important is from day one, if you do not have SIP, which is systemic investment plan, make sure some amount of your money every month should be going into SIP. Every month, whatever date you like, whichever date you feel lucky, put an SIP plan and start that immediately. It's a must, and the best way of investment is your SIP. Systematic investment plan in mutual funds, either index funds or ETF or mutual funds. People know various methods of applying mutual fund. You can apply it online. You can take it physically in the form way. You can take from the mobile apps nowadays, or you can take from the banks and distributors. I would not advise between banks and distributors because they will give you regular mutual funds. Better to do it directly because that's a direct mutual funds. The most important being is there's no commission in the brokerage and there's less expense fee. Okay, there will be commission and brokerage with the fund will have to give to the broker who will be going to the bank. There's higher expense because they need to give the money back. Okay. And the NIV between direct fund and the regular fund will always be a difference of 10 to 20%. So it's always good to go for the direct mutual fund. Look at this. If you look at S&P, if you had invested 30 years back, 10,000 rupees or $10,000 in mutual funds and 10,000 in index funds. Okay. What will your return be after 30 years? Your return will be nearly same. Okay, the difference between mutual fund and index fund is only about 25,000 rupees or dollars. But see the fees you have paid. As a mutual fund, you have paid 1,40,000. As an index fund, you have paid 4,000. Your returns are same, but the fee you are paid is 36% in your mutual funds, and you paid 1.8% in your index fund. Hence, index funds are something which is really picked up. It's just come out. A lot of index funds have come out over the last 10 years. I think SIP in index funds is way to go. Mutual funds, we know that unlucky 7 is happening in the last 7 years. 88% of large cap mutual funds have failed to beat the benchmark in the last 7 years. Hence, I would say that it's good to go ahead with mutual funds and to put in index funds. This is what it says. The important over here is whether it's ETF or index funds, you see the return. The return over last 5 years in index funds and ETF funds are nearly 16%. Last 1 year is 56 or 35%. So between index or ETF, there's nothing difference. I would say that keep it basic. Add 4 Bs or index funds to cover your 500 stocks. Your first Nifty 50, your next Nifty 50, that's your 100 stocks, your mid cap of 150, and your small cap of 250. What percentage you want to invest, we can discuss it. Put an SIP every month. Whenever there's a dip of 5%, add 1 SIP in all of them. Whenever market goes down by 10%, add 2 SIPs in it. Okay? It is called a sip and dip. Continue SIP, and when it's dip, keep on adding. Let it compound. Mutual funds, unlike real estate and equity, which takes 10 to 14 years, mutual funds start compounding after 7 years. So I would say start now. All the best. Don't wait. Large cap ETF, some of the example, Nifty B is for large cap ETF. HDFC Nifty is your index funds. Same thing with your next 50. You can invest 50%, always index in the higher bracket because it's for the risk reward. It is more safe. So I would put 30% in next 50, 20% in the next 50, like that. Mid cap, I'll put 30%. Small cap, I'll put 20% for the risk benefit. Some would change it differently. Instead of keeping 50-50, would keep 60% on higher and 40% in the lower. These all are just example. I'm not promoting all this index funds or ETFs. I'm just giving you example of what they are there. So in case of index fund or ETF, the age of the fund does not matter. You don't have to wait for 10 years. The small cap have just come recently. So people will say it's only 2 years or 3 years of small cap index fund and ETF. Please don't worry. Start putting in the small cap index fund. Okay. Percentage of how much to put where you have to decide and depends on you. If you're above 65, do not put in mid cap and small cap. Just go in the top 100 funds. If you want to diversify further than index and ETF, I would suggest that have 2 more mutual funds. You can have a flexi cap or you can have a small cap. So that is the in short. Keep 4 to 6 mutual funds. Don't create a zoo of mutual funds. Once you start putting in mutual funds, let it grow. Okay. Once you're growing, the earlier you start, the more amount you get. If you start at 20 and if you start at 40, you put the same 1,000 rupees SIP, you will get 5 times the money. If you start at 30, you'll get 3 times the money if you start at 40. So keeping that in mind, if you're going to start late, invest more. Compounding is very important. Dr. Harish's chart is there, which is very good and which will help you to see how compounding helps. You can use Dr. Harish's chart or you can use other chart. Sir, can I go diversify for 5 minutes and go to the Dr. Harsh's chart and show the group?
Go ahead, sir.
So this is a gem of a chart which he's made it and it's beautiful. I see. Can you all see the chart?
Yeah.
So now you're looking at an SIP. If you're putting SIP of 50,000 every month, you are getting an increment. Every year you're increasing SIP by 10%. So if in the first year, every month I'm putting 50,000, next year I'm putting an increment of 10%. So I'm putting 55,000. That way, every year for next 20 years, I'm going to put an increment. So how my 50,000 after 20 years becomes 9.5 CR. Just putting 50,000 every month and increasing by 10% becomes 9.5 CR. Suppose people feel that I don't want to put 10% increment every year, you can just delete it. And if you just keep on putting 50,000 every year, even after 20 years, you'll get with 4.5 CR. Okay. So this is how it keeps on happening if you keep on adding. Suppose now tomorrow, I want to decrease the number. I want to buy a flat. I want to invest in a hospital. My investment year is 5 years. I'm going to put fixed amount 50,000 every year. Okay. 50,000 every month. And then I'll see that after 5 years, how much do I have? I have 40 lakhs. After 7 years, I have 64 lakhs. So I have 50 lakhs to 64 lakhs to put as my deposit for the next commercial value or a rental flat I want to buy for my commercial use. So that's what I would do is I would always advise that when you start SIP, keep SIP, different SIPs for your different plans. Retirement plan, keep one SIP, one lot of SIP, second lot of on the second in your wife's name or somebody's name, you make a second SIP for you to start for your commercial venture, for your real estate investment. When your kids come or anything, you can start in your kids' name for their investment, for their education, and if you want for their thing. So all the things you can have a different SIP for different reason why you want to start. And this is a beautiful chart. If anybody wants, Dr. Hirsch or myself can put it in the group whenever you all want it. Similar, lots of charts are available. Please use them and make a plan so you can see how it goes. So this is very important of compounding. Can you see my slides? I'm back on my slides.
Yeah. But you make it full screen, sir.
Okay.
Yes.
So that is about compounding. Second thing is your debt fund. Debt fund is when you want to invest for 3 to 5 years, when you want to plan for something short term. Okay. It is very low risk. And you can encash in any times, but low risk gives a minimal return of 5 to 10%. Debt funds are low risk, but you see that debt funds are the funds which are easily available. You can have your corporate bonds, you have government bonds, RBI bonds, state bonds, and central bonds. Okay, you can have bank certificate or even your pension plan, even your mental block. So your fixed deposit, all can be part of your debt fund. People forget that debt fund is 3 times the volume of your equity. Okay, debt fund in 2020 when its peak was 22 trillion Indian rupee. Now with people investing more in equity, debt fund has halved in last 3 years. So debt fund is coming down, but that does not mean people should not have debt funds. I feel that 3 to 5% of a debt fund before you are 60 you should have. Once you reach 60, you can start increasing your debt funds for it. And the idea of debt fund is to risk reward. When you have too much in equity, start pouring it out into debt funds. Don't be too concentrated in your risk into equity, because as we said that when we talk about risk of equity is that equity often goes down, and that is the time when your debt fund helps you. Debt fund time frame is 3 to 5 years. Equity can take 2 to 3 years to start coming up, and that's where your debt fund will help you. There are various type of debt funds which we spoke about. The important fund is the liquid fund over here and arbitrage fund over there, which are good debt funds to give whenever you need it. Advantages: low risk, guaranteed return. You can diversify, but the disadvantages, the returns are low. It's inflation that your debt fund will go lower down. Okay, various categories of mutual funds, equity and debt funds, or you can go for a hybrid, which is combination of both 70 equity, 30 debt funds or 80. So I usually say go for equity and go for some hybrid funds. I do not like to go into NFO or different type of schematic mutual funds. I feel that they are waste of money and they have a lot of expense accounts with that. So have a mutual fund, part of your mutual fund, which is 20% of your full portfolio, or 40% if you don't want to in equity. Always keep an aggressive or moderate plan. Even when you want to retire, I do not try to be conservative, is where majority of your debt fund is in growth scheme, some part is in balance scheme, and very few part is your income and money market scheme. Okay, so keep your portfolio quite aggressive when you are young. When you are old, you can or slightly elderly, you can go to moderate plan. Until you're finally thinking and the end of your retirement, you can just go to conservative plan. So there are various plans just to show you, highlight you, and you know what to know. Final part is equity. I'm discussing equity last. It's slightly complex. At the same time, one does not need equity to create wealth. Let's be very clear. With gold, with real estate, with mutual funds, you can create enough wealth on its own. But you want to multiply or compound your wealth and you have agreed, then you can go for equity as well. But remember, before going to equity, it takes years of reading and to be able to read the balance sheet, the charts, and everything before you should start. Otherwise, you'll make the same mistake I made, and I lost 15 years of my investment life where I lost money in equity. You need to have time. One you want to dedicate, you need to have dedicated minutes or hours per day or per week in the beginning. You need to be patient. You need to have acceptance of failure, and you need to persevere once you are going to equity. These are the basic things of equity. I can't talk about equity as a whole in last 10 minutes, 5 to 7 minutes, because obviously there's a good topic of equity with Naresh Biani and Chape Soran given in our library. Please look it up. But important on equity is look at the Sensex, how it is like a roller coaster and how it can go up and down every year. 2008, it was down by nearly 40%. Okay. During Herschel Mehta also, it was down by 40%. In 2000, it didn't go down so badly. It was down by 20%. But equity will keep on going up and down. And that's why you need to remember that. At the same time, in equity, remember change. Change is a buzzword in equity. Out of 30 original, 1970, 1981 when equity was, 86 when equity was started, BSE 30 companies. Out of those 30 companies, now out of 50 years, only 7 companies exist. 23 companies have got bankrupt or are no longer there. So equity has a risk. So when you talk about equity, you have to talk about risk, reward. You need to be alert and you need to be reading about it all the time. You know your risk tolerance when you want for equity. How much money you want to risk in when you can handle your investment. What are the factors which will determine your risk tolerance? Amount of money you have to lose. Suppose if I lose that money, I should feel okay. How much time you can give in that amount? How, if you lose money, you can emotionally handle it. When you are young, you can handle it better. You don't care. You have your whole life. When you're older, you have to be a little bit more safe about it. Determine what kind of investment you want to pursue. There is no right or wrong way to do investment. It's all about risk reward. Before you start investing in equity, do I understand stock market? What is my risk appetite? What is my investment goal? And do I have a plan? Make sure you answer all these 4, and then you start talking about investment in equity. Equity or stock is nothing but you're buying a part of a company. You're becoming a partner in a company, and hence it's called as equity or share. A company can go up and down. A price of a share can go up and down nearly daily. The type of money you make in equity is that one which you can get dividend, which they give it every year. But remember, dividend is not confirmed. Dividend is not a promise. If the share market goes down, if the company goes down, you might not get dividend. If it does very well, you get more dividend. Okay. There's a risk, as we said, the company can go bankrupt or the company can have bad phase, which you need to bear it out. Whenever you're investing in equity, you have to remember there will be downturn. Okay, downturn of 2000, downturn of 2008, downturn of COVID. The downturn can go up to 20 to 40%. But remember, if you wait out, be patient, be perseverance, and be persistent, you will get money out of it, and you can go up to 100% profit if you invest over the time of more than 10 to 20 years in equity. Make sure you know your risk. Okay, there's no guarantee you'll make money, no guarantee of dividend. But the bright side is equity outperforms all investment when taken into the risk. Okay, so equity has shown to make an average return of 10 to 12%. Equity, you need an account, you need a trading account or broking account, and you need a demat account. The types of equity, mostly we'll talk about common shares, which you buy off. You get preferential shares with the companies will give you before IPO. We'll not go for it. But the important thing is to buy equity, you can buy either as a primary through IPO. Nowadays, I don't believe in IPO, but IPO is more like a lottery. You can apply for it, but most of the time we don't get it. Most of the time when we buy equity from the trading market, which is your NSE or BSE. So buy your stock prices from the equity. Stocks are volatile. You do not look at it daily, but make sure when you buy, you have your fundamentals and you're determined about what you are buying. Before buying anything, analyze. Investment without analysis, like driving on a highway blindfolded. Analyze the equity market. Give an active approach. Okay, looking at the prospect of the investment in equity. Understand the past performance of the company, how secure is the company, and what's going to happen in the future. While doing your due diligence, look at the company. Is it increasing its revenue? Is the company actually making a profit? Is the company able to repay its debt? What is its debt ratio to its profit ratio? Is the company in its competent? Is the company a leader in its own industry? Paint industry, is the company a leader? Asian Paint, is it a leader in the paint? Okay. In the bank, SBI, HDFC, is it a leader? Finances, who is the leader? Manufacturer, who is the leader? Find who is the leader in it. Do your due diligence by looking at stock exchange websites, companies' website, industrial research websites. Do not try to do it from your newspaper or magazine. By the time it comes in newspaper or magazine, the horse is already bolted. And do not look at social media. Okay, social media, your friends and all of us put something, but after that, it's your job to go through everything and do your own research. It's your own money. Make sure you do it and go through the research. For the time being, I'm going to skip through some slides. Okay. Remember to educate yourself. SBI spends less than 5% of corpus for our education. So we are lucky that groups like this are helping you to invest and do your investment on its own. So one most important of the basic stock selection is know the economics, know the fundamentals, and know the technicals of the company. Okay. What do I mean? The most important is the fundamental is what is the company doing? How good is the company? Okay. Analyze the company and make sure what is the true value of the stock of the company. Economy, look at the economy of the country. When we say we diversify to America or India, we look at the GDP is going up. We don't diversify to China because the GDP is down, the indices are down. Look at the indices, look at the unemployment rate, look at the inflation rate, look at the consumer's confidence, look at the purchasing power. People have more money, the consumers will buy more, the purchasing power is more. Okay, fundamentally, most important is who is managing the company. Are the people reliable? Look at their record. Have they good corporate governance? India is very poor in letting companies know about how good they should be in corporate governance. A lot of good companies have poor corporate governance. In spite of them, they become 2 or 3x in the last 3 to 5 years. They fall down because the corporate governance come out. People forget about it and people reinvest in it because the company is good. But people do not hold management responsible for poor corporate governance. This is where the India should get strong in corporate governance over the next 10 years. And they should be penalized when they do wrongs. Okay. How good is the company in the industry and how good it is with competition? Look at the balance sheet. Quantitatively, you need to look at the balance sheet and know your figures. These are the hallmark of doing basic fundamental analysis is looking at the balance sheet, looking at the revenue it's making, how profit it is, how good it is in the industry, how good is the management, and how is the country doing. This is called as fundamental analysis of a company and which you need to. The important points which you need to see, a lot of ratios which you need to see. But for those ratios, please look at the Dr. Shapesh Soren and you will see. Second thing of fundamental investment and second is technical investment. Technical investment is usually short term. You're looking at the charts and you're deciding what to do. Okay, you're looking at the charts and seeing when the charts are breakthroughing, what is the relative strength, what is the support level, and all that. The basic difference is fundamental analysis for long-term approach, technical analysis for short-term approach. It's for when to enter, when to exit a good company. You can combine both of them and do it. And then that way the best is to do combination of both. The takeaway is Stock investing is a long term with low risk, while trading aims for quick profit with higher risk. The decision should be based on your goal, your risk tolerance, your time horizon. Learn about stock market before investing. Find which method suits you and see the pros and cons. In summary, for equity, technical analysis performed on the price movement and the market physiology, market psychology. Fundamental analysis look at the company per se and the economy of the whole picture. Both have their strength and limitation, and the best way, there's nothing either or. The best is to have a combination of both. Important thing when you buy is buy right and sit tight. Buy right and sit tight means you buy and keep it invested for more than 10 years. The risk of losing money decreases drastically. There's nothing risk-free, but the thing, if you buy equity, you keep for more than 10 years, the risk of losing money is only up to 60%. When you invest in equity, timing is always right. When you like a company, your money, like SIP, when you do buy it and see. If you invest it for more than 10 years, you can see over here how the money is increasing and how you get good returns in equity from 20% to 35% when you invested in these are the Nifty 50 companies over here for last 10 years. The important in equity, what I feel is do your QGLP. QGLP is very simple. Look at the quality of the company, look at the growth of the company, look at the longevity of the company, and find what the company prices are. Okay, so it's very important to make sure the company is doing well. Good companies do well both when there's a bull market and when there's a bear market. Bull market when the market is going up, or the bear market when the market is coming down. Both of them do well. The idea is that to invest in equity, because it gives you maximum return over long term, it creates wealth of the wealth. If you invested 100 rupee in Sensex in 1979, you would have multiplied your wealth by 2,684 by now, including dividend. So if you want to really create big wealth, you need to invest in equity. But remember, you need to keep an eye. You need to diversify your portfolio with risk. 20 equity stocks are good enough to decrease your risk. Increasing your portfolio more will not decrease your risk, but will dilute your portfolio more. So be careful. So point for stocks, enter after a minimum of 5 to 7 years of experience of doing investment. Trading after another 5 to 7 years of equity investment. As you see, I'm investing into trading after 20 years. You have to read, learn, and practice for a few years. Diversify into 15 to 25 stocks, 20 at the max, 80 large caps, 20 mid caps, avoid small caps and micro caps when you're investing in stock initially, unless you have become a pro and you're a trader after 20 years. Don't indulge in reckless behavior like doing an FN and other speculative indices. Again, going through my 10 commandments, which you all know, is that please diversify. Your money is important. Your money, you will take care. Invest in gold. Gold will remain gold. Real estate rarely loses money, gives you good return. Start SIP, start index mutual funds and index funds. Do not be scared of the direct stocks. But if you don't want to take risks, it's okay to create wealth without direct stocks. But if you want to create super wealth, then think of direct stocks. Most important, time in the market, compounding of more than 10 years is very important. Time frame, usually we say gold is 10 years. Real estate and equity direct is about 10 to 20 years. Mutual funds is more than 7 years. Debt fund is less than 5 years. Investing money is a process of committing resources in a strategic way to accomplish a specific object. So have a strategy, have an object when you want to invest in it. With that, I finish. Any questions, I'll take it. Thank you. After that, if you want, you can email or WhatsApp me and I can talk to it. Before I take for questioning, I just want one thing. As a lot of you know that I'm growing hair. It's not for me wanting to grow my long hair, but it is for cut for cancer, donation for hair for patients to make wig. Ladies with CA breast, kids with leukemia need a hair for donation. Thank you.
Wonderful talk, Dr. Amish Voraji. You have really gone to a wide spectrum of available investment avenues. It was an amazing talk. You have taken us on a rainbow of pot of gold to be created, both for youngsters and experienced people, and also for the old people. Thank you very much. I'll just try and give a brief 1 minute brief points what you have said, so that those who have joined late, but I request members to join on time so that you should not miss the beginning of the talk, which is very, very important, because the speaker takes a lot of trouble in presenting his talk in the first few slides, so that what is coming subsequently becomes very easy to us. Nevertheless, those who have missed Dr. Amish's talk will be again given an opportunity to see subsequently in the YouTube, but after some time. And those who have joined later on in our WhatsApp group and asking for the earlier talks, which Dr. Amish has alluded to many times in his talk, to different topics by different speakers. All of them are there. About 65 talks are there in the YouTube. I have posted the link in our chat box here. And also, I will post the link in the WhatsApp group, those who have joined our WhatsApp group. Now, sir has taken us a very wide arch of investment. I would say he started with a good financial planning, keeping in mind the 10 commandments of diversification and also investment policy as a whole, to so that the main, I think the crux of sir was not to lose money, as he has enumerated in past 30 years or 40 years, where he has lost money, he has lost time. So people who are joining as doctors, we are very so-called highly intelligent professionals, and also with the lack of time, don't lose money in investments or in financial markets, and go through the topics which are golden messages. See, these topics which you will see free of cost from Indian Academy of Pediatrics by the doctors. I have seen just now before coming here, each talk you have to see by paying something. They are paid talks in many of the doctors' talks, many of the other talks. And these are genuine talks with no ulterior motives. They are not sponsored talks. So please go through them. So sir said greed, how to avoid the risk mitigation of your investment is focus on asset classes like GREED. What he said, G is gold, RE is real estate. It's a big ticket investment, not very, very, all of us will afford. After some wealth generation, you can do equity and debt fund. And of course, foreign currency or currency market, and also derivative, what do you call, commodities are there, which we are not going to touch, nor we will advocate so much. FNO, definitely right now, no, it requires tremendous amount of experience and knowledge and practice to indulge in it. The safest, what sir has said, is put some money in allocation according to your age. Start very early. For example, start investing the first income of your profession. Set aside some savings. Start from 20%, go up to 50%, and you can even go above that if you can save without indulging in extravaganza or extravagant life. So gold, equity, mutual fund, and debt funds is what he has emphasized. He has clearly said allocation in various types of age groups, below 30 years, 30 to 50 years, above 50 years. And he has also mentioned about how to select the mutual fund. I would add to sir's lecture, DGO. Remember, when you select a mutual fund, he mentioned very nicely, it should be a direct mutual fund, it should be a growth mutual fund, and it should be an open mutual fund, which means you can come in and come out whenever you like when your goal is over. So always opt for a direct mutual fund and an open mutual fund and a growth mutual fund, which means the dividends are adding into the main fund, and then you go compounding it later in your life. So keep it simple strategies. What I would suggest, the F3 team always emphasizes that keep it very, very simple. Don't make your life complex. Don't make it complicated by investing into the products which you don't understand. invest in the products which you very clearly understand. Sir has told that he has taken so much time to invest in equity and so much time to even do the trading in F&O. So it requires experience, it requires trial and error, but this trial and error should not be costly for us. You should not suddenly get wiped out with one stroke. See, the equity market is very good because the asset class sir has expanded is 14%. It gives overall historically over 100 years. Any market in the world, American market or Indian market, or for that matter, European, most of the countries market. So average, we have seen that it is the highest asset class in returns. And also it has got a high risk factor. But we are in the peak, sir has said, gold and also equity in the cycle. We will go into recession or a bear market. But remember, many times our friends have posted bear market is smaller and smaller, shrinking 2 years, 3 years. And the bull market is expanding longer and longer. We are in an extended bull market in India from past almost 7 to 10 years now. I think we are passing that. The only country who had an extended bear market is Japan, 30 to 40 years, still struggling with it. You have recently seen it knocked out American equity market by the interest rates, which it was banks were not generating 0% for so many decades. So it is unusual to have a long bear market, both in equity, both in real estate, both in gold, both in mutual fund. So diversify your asset classes slowly and steadily, build up your portfolio. In equity, for all newbies and newcomers, and I also do that, try to invest in equity funds. The best equity fund, sir has already mentioned, and we have got about 10 talks on various doctors in our YouTube channel. Please go through them. Nifty 50 index fund, Nifty next 50, mid caps. Probably those who are little adventurous go for small caps. So these are few of the things he has alluded to. He has given a wide talk. We will go into detail of each topic when you have time, and we will come back to you also in discussion part. Sir will be available in our WhatsApp group. Those who have got further questions can ask him. And currently there are certain questions, sir. Will you take them, sir? Some questions in the chat box.
Okay, sure. I've been trying to look at it. I'm not be able to open the chat.
I will try and see if Harish Gopal sir is there. He can take. Harish Gopal sir, are you there? Well, Dr. Mehula said keep one talk on webinar on Forex and crypto. Crypto, we are not at all encouraging, but we had a blockchain talk by Dr. Harish Gopal earlier to make you understand what is crypto based on. And taxation, he has not touched at all. We have got a chartered accountant in our WhatsApp group, Dr. Balwan Jain sir, and we already had a couple of talks available. And it is a dynamic subject, taxation, and we should be aware of it and learn with every budgeting and post budgeting. Yeah, sir. Compounding chart, they are asking you to put in the WhatsApp group, sir, if you don't mind. Dr. Harish Gopal sir's compounding talk.
Sure, sure.
So, LTCG, that is long-term capital gain and short-term capital gain. Can you throw some light on this financial instrument if you want, sir? And briefly, 1 or 2 sentences if possible.
Sure. So short-term capital gain depends on the class of the asset you're talking about. Most time we are talking about the class, so let's say equity. In equity, short-term capital gain applies after it's less than 1 year, and long-term is if it's invested for more than 1 year. If it's less than 1 year, the short-term capital gain is about 20%, the tax on it, and long-term capital gain is about 12.5%. Okay, and same thing happens in real estate. In real estate, when you're talking about short-term and capital gain, the short-term is about 20% without indexation. Now the indexation has come back. They've made it more complicated, but I feel that it's still about 20% with indexation, no indexation benefit. For long-term capital gain, there's an indexation benefit, and you can go for either 12.5% with indexation benefit or 20% without indexation benefit. So capital gain, the short-term capital gain, and the important thing is do not worry about capital gain. You make money, be happy to give your taxation. Okay, worried about taxation, people don't invest. I feel it's wrong. Second thing is worrying about taxes and making black money is even more wrong. Time has changed. In our grandfather's time, having cash, investing in cash, buying gold in cash, and keeping cash was fine. In today's day and age, try to keep everything clear, pay your taxes, pay your money in equity and white, and let it multiply. Okay, we all know, we all have stories where our fathers have given money to somebody and that person expired in cash and now he's not giving the money back. So cash per se, it's your hard-earned cash. Do not, your own money, do not worry about it. And don't worry about taxation. Use your taxes CA, let him also make some money. It's like doctors, when we charge, we need our professional charge. Let your CA need your charge and do it. Be aware of a capital gain. Okay. And from that, you can see most important short-term capital gain is always in your equity, which is about 20%. Long-term, don't worry, whether it's equity or real estate. Invest in your market for 5 to 10 years minimum, and you'll make enough profit for you to pay your taxes properly.
And there is a question on REIT, sir, Real Estate Investment Trust. What is your opinion on that?
See, real estate investment trust is something new. And it's 2 to 3 years now, it's coming up into play. I feel that anything which comes like a NFO or anything, I wait for 5 to 10 years for it to get its history correct. And then we can decide of investing in RIT. A lot of people have gone into it, have invested. We know that when the indexation was removed from it, our REIT dropped down drastically, and this will up and down will happen. Until we understand it fully, I would wait it out. When it comes to real estate, I feel age all, having a property physically which you see, which you can monitor, you can manage is excellent. If not, investing in equity of your real estate companies or equity in infrastructure companies, which are even bigger part of RIT, is very good. You have massive infrastructure companies which are doing very well. You have nowadays good real estate equity companies which are doing well. You can invest in it. But remember, when you invest in them, you have to invest in them for long term.
See, this is what experience teaches you. What Dr. Mishra is saying, REIT is a new concept in India, and only 1 or 2, 3 companies are leaders in the market, and they are not doing that well as in Western countries REIT. When the ocean of investment is so widely available to us and there's so many good instruments are there, why do you want to search for exotic instruments? There is a real estate mutual fund. There is a real estate share market, and stocks and companies are there. Then you can, investment companies are there. I would, we can enumerate at least 5 or 6. So industry category, you take the top 2 leaders of that category and then invest. So you will have a very good diversification. So don't go for complicated or unknown or newer instrument or any new trend or what you call fad in the market. Whatever is established, try to own that and hold it for a long time. Don't time the market. Be in the time as much as possible. Sir, anything about SWP, which means a systemic withdrawal plan?
So, excellent question. SWP is your systemic withdrawal plan from your mutual funds, or you have a plan where you want to sell your equity in a systemic manner every monthly. SWP is the opposite of SIP. SIP is systemic investment plan, while SWP is your systemic withdrawal plan. Once we retire, whatever age, 65, 70, Okay, then we want to decrease the work or we want to stop working. Then we need to make sure that the wealth we have created can sustain us for next 20, 30 years. And hence we make a plan. Usually what you have invested, 4% of it, you can straight away remove every month, every yearly, and then you can get a monthly removal of it for every month. You say, okay, so I want 1 lakh per year, 1 lakh per day, month is my expense after when I'm 65. Okay, so I need to remove 12 lakhs every year. My portfolio should be such that the 4% I remove every year will give me 12 lakhs a year. Accordingly, I will make an SWP of 1 lakh every month from it. So every month, 1 lakh will come out from my investment and will give it to me to sustain myself. Okay, just as you give an order for systemic investment plan, you can give a order for systemic withdrawal plan. But you need to remember that when you are withdrawing up to that amount, your portfolio should be 25x by the time you retire. Okay, so if I want a plan of having 12 lakhs in expense just now, my portfolio when I retire after should be 12 multiplied by 25, approximately 3 CR. If I invest if I have a portfolio of 3 CR, I can have a beautiful SWP, making sure with inflation my money comes down, plus my return is higher than the inflation, the equation works beautifully. When you read your retirement plan, there's a beautiful 2 talks given by on retirement plan and SWP, how you should divide your mutual funds into debt funds and mutual funds, 50-50, 60-40, how you to go about it. You can decide based on that talk which was given a couple of months back. So look at that talk on retirement. It's very good.
What exactly, sir, means that our longevity is increasing after retirement. So you make a corpus and every month, whatever you need, not more than 4 to 6% you must withdraw so that the corpus lasts for 30 years. I think, sir, we have almost answered all the questions. And on behalf of the Pediatric Academy of Telangana and our F3 group from Dr. Pawan, Dr. Harish Gopal, and other team members and faculty and admins, and the office bearers of Pediatric Academy of Telangana and Twin Cities branch of IAP, Hyderabad and Secunderabad, I thank you immensely for taking so much trouble and effort in making this talk wonderfully presented. We were eagerly awaiting it, and today we had a feast of information from your valuable, wise talks. Thank you very much. And I request Dr. Pawan to say a few words and Dr. Harish Gopal before we end and call for a day. And I have 1 or 2 announcements after that. Dr. Pawan.
Sir, Amit sir, I think really it's an awesome talk, sir. I think you have covered everything, right from the basics to advance, how we need to go through, and you made the talk so simple and naive that even a beginner who naive to finances can easily understand. Hats off to your passion, sir. That show the clarity with which you have worked hard in creating this PowerPoint to deliver us, sir. Thank you so much. Hats off from the gratitude from my core of my heart and also from Pediatric Academy of Telangana State. So we have a deep gratitude for you, sir, for conducting this session. Thank you so much, sir.
Thank you, Dr. Pawan, for that.
Anybody can unmute and ask and, give your feedback to sir also. It's our honor to appreciate sir for taking us time on Sunday afternoon and to delivering this wonderful talk. You can all unmute yourself and you can speak.
Thank you. Thank you. Thank you for your kind words.
He is a noble man who's doing a noble service of growing his hair and donating for the cancer patient. That itself shows that from the purity and charity what you are having, and to make doctors aware of the finance knowledge and literacy. Thank you very much for that, sir.
Thank you, sir.
Thank you, sir. Thank you very much, sir.
Yeah. Before I close finally today's talk, I have 1 or 2 announcements. As I told you, January 8th, 2025, we are going to have a national workshop on financial literacy and financial talks, a full day program in Hyderabad. It will be a physical program to start with. It is already there in the website of the Pedicon 2025 workshop list. You can enroll. People have started joining. I have seen a couple of people have already enrolled. And we have kept the fee only 500 rupees, and we have kept a limitation of not more than the allowable capacity in the hall of the hotel where we are going to conduct this program. And all the, I promise you, our top doctors of our group will be there to teach you hands-on on each topic separately at a station level post theoretical presentation, but it will be mostly a practical, you will go home with rich experience and practical knowledge. So I request you to enroll there. And meanwhile, I'll also announcing those who are interested in teaching further and taking some classes, please WhatsApp me or call me up and message me. I will definitely discuss with you what are the topics we must take and to spread this literacy among the doctors in our group. And lastly, we will have exciting prizes during the workshop in January 8, on January 8, 2025. We are still working on it, but I can assure you there will be a lot of finance books will be presented. There can be a quiz also. There will also be some sort of a poster session on which are the best instruments, how to go about on a single poster, which are the best books to read, the top 5 books and the summary, or at least the main points on it, and which are the other instruments like in mutual funds, which are the best mutual funds to category wise to invest, what are the way to select all these things. We will open up and we will talk about it. And I request you to contribute, learn and share in the group. Thank you very much. And this will be our last but not the least month for the talks. September, we are trying to close down in the 30th September with 2 more talks. Whole of October, November, December, we will not have any webinars. We will be preparing for the physical workshop in January. Hence, September, there are 2 more talks pending on the alternate Sunday, that is on the 2nd Sunday and the 4th Sunday of the month. And thank you, Dr. Harish Gopal, who's doing academically the work for selection of the topics and the selection of the program and the speakers. And I thank all the speakers to voluntarily who have come here and spread their knowledge and use their time to teach all of us this new subject of financial literacy. Thank you very much. Good evening.
Got it.
You can leave.